In this video, we're going to talk a little bit more about what I guess I refer to kind of like as process, right? What is it that managers do and how should they think when they are running our companies? So we're going to talk about the goals. What are the goals? What should they be doing? And then we're going to talk about the conflicts that we have, and that's what is referred to here as agency. So let's work our way through and talk about goals. What is the correct goal? There are many objectives that a company can take, but what is the thing, the primary fundamental purpose of a business? And a business, especially not for profits or for profits, is to generate wealth for the shareholder. So maximizing profit is a good idea. Obviously, we want more profit than less. Certainly, we should be trying to minimize costs. We also want to maximize the market share of the company. But the fundamental underlying goal is to maximize shareholder wealth. And of course, that refers to the stock price. So a basic statement that we can make is that most shareholders agree that they're better off if management makes decisions that maximize the value of their shares. But why not profit? Why not think about maximizing profit? What we're saying here is not that profit is bad or that we shouldn't think about it. Certainly we should always be thinking about profits. But we're talking about making decisions. If you make a decision, what should be the variable that you use to help you decide to move forward or not move forward? And the challenge with profit is it's not the best benchmark, if you will, for making decisions. Why? It is backward looking. It doesn't think about or even consider what might happen in the future. It's certainly dependent on accounting principles. Right? The accounting principles develop the financial statements. And if you can change accounting principles, that means you can change profit, which creates some issues with understanding and using it as a variable in a model to decide to do a project or not do a project. It also doesn't consider all the cash flows. So it doesn't look at cash flow, it only looks at net income, which is an accounting number. And we know from some of our discussion that cash is the most important concept when we think about doing things for a company. In addition, it ignores risk. And we'll talk about this hopefully by the time we're done with these videos. You'll be able to see how risk fits into understanding how to make decisions. So maximizing shareholder wealth, modern finance claims this is the proper benchmark. Maximizing stock price, not profits, is the measure that we want when we're thinking about models. Again, I want to kind of come back and say profit's not bad, profit is good, but we can't use it as the variable to make the decision. Why? Well, the things that we talked about above. So shareholders are the residual claimants, right? They get nothing unless there's something left over. So there's no incentive for them to bear any risk unless they have some hope for return. And where does the return for stocks come from? Obviously, it comes from dividends and it comes from price appreciation. With respect to the society, obviously we think that if you're maximizing value of the firm, that's what's good for society. As long as nobody else is made worse off by a company's decisions, increasing the value of that company's equity is good for society. It does become an issue when that increase of value comes at the expense of others, obviously. So the next concept to talk about here is ethics. And primarily what we want to concentrate on here is the concept of agency. Agency problems arise because managers are not directly tied to the ownership of the company. So managers may act in their own interest rather than in the best interest of their shareholders. So how can we fix this? Well, maybe we can tie management's compensation somehow to the company. But how are we ultimately going to measure this performance, right? And there's lots of ways that we can talk about and think about agency itself, but we want to concentrate right now primarily on the idea that managers need to act in their own best interest, and that's what causes the issue. So if a CEO is performing poorly, right, how can shareholders complain, right? What can they do? Well, the one thing they can do, obviously, is sell their stock. So if things are not going poorly, right, owners, one of their choices is to sell off stock. And of course, this pressure drives down the price. And if the stocks get low enough, then there are others out there that may come in and take over the company. And of course, the current management doesn't want that to happen. So if a company comes over, takes over, gets rid of the old management team that apparently wasn't getting the job done, certainly then what we would expect is that the stock price to rise at that point. So again, what is this agency principle all about? A principal hires an agent to represent his or her best interest. Stockholders hire managers to run the company. And again, the conflict comes into play when one of those team members, in this case the agents, right, do things that are not in the best interest of owners. So what can we do to help, why is it that there is this conflict? And they give several different reasons here. They talk about expensive perks, right? We know that management teams from time to time will do things that you just wonder why they're doing them. They cost money. They provide very little or any cash flow to the company. So why do they do these things? Well, sometimes it's because it's part of the benefits plan. But sometimes they act in ways that are in their best interest just on a survival basis. There are lots of things in mergers and acquisitions where managers do things that actually hurt the company to make it look bad so nobody will buy it, so they won't lose their job. So again, thinking about these goals, why does management do what they do? A lot of it has to do with just being a human being and thinking about survival, controlling your business. So how can we get management to do the right thing? One of the things we might do is offer them options, right? Stock options, right? So we want the incentives to come in line with that of being an owner. And of course, if you give them the option to buy stock, that gives them the option to become an owner. And they would work in their best interest to make themselves wealthier, which now ties into play with the company. And of course, there's lots of incentives that we can utilize to help managers do the right thing. So again, that's how we can ultimately manage managers, if you will, to get them to do the right thing. Just briefly, there's only a couple of regulations that I think are really of great importance in corporate finance, at least to understand why we do the things we do. The Securities Act of 1933 has to do with the issuing of brand new securities. Sometimes it's called the Information Act. It requires registration and specific kinds of information to be provided to the Securities and Exchange Commission before a security can legally be issued and sold. The Securities Exchange Act of 34 created the SEC, so that provided now this regulatory agency. But in addition, this Exchange Act also sets the guidelines for brokers, for excuse me, for brokers, for the information is provided after the stock is issued, and how the exchanges themselves operate. And finally, the most recent things I think has had a great deal of impact on business in general, and I'm sure you've heard of this, is called the Sarbanes-Oxley Act. And the Sarbanes-Oxley Act it increases required reporting requirements, and it places much more responsibility on the shoulders of corporate directors. So one of the things that the Sarbanes-Oxley Act did was it now requires CEO and CFO to sign the audited financial statements. Now, they always had to sign them. But what would happen if there was information within the annual report that was fraudulent, wrong, illegal? Well, they could get sued, but they could only get sued as a they could only get sued outside of the criminal court, right? So it's a civil matter, not a criminal matter. But now it's actually a criminal matter. So if they signed and later it turns out that there was fraudulent, illegal action inside, not only can they now be fined, but they also can serve some court time or some jail time. So again, that's the basis for our thinking, our decision-making process. So if we think about managers, right? Managers should be working to efficiently run a company. They should be looking at ways to do this in a way that certainly is ethical and legal. But in the end, their goal, the goal of a manager, is to make the stock price of the company go up. Their job is to make the owners of a company wealthy. And if you take this to the most simplest kind of company that you can think about a sole proprietorship. Would that owner do anything that would hurt their individual wealth on purpose, right? I mean, they'll make mistakes and hurt themselves, but would they do it on purpose as a conflict? And the answer is, of course, no, because the managers and the owners are the same people, right? So again, the idea of agency, the idea of managers running a company for owners, there are conflicts that we have to be aware of. But the basic process is managers work for the owners of a company, and their job is to make those owners wealthier. That's it for this video. See you next time.